What's happening right now in the precious metals market is something most people won't see until it's too late. And by then, the opportunity will have passed them by. We're standing at a crossroads that only comes around once in a generation, maybe once in a lifetime. The signs are everywhere if you know where to look. Central banks are moving. Institutions are repositioning. The smart money is already making their moves. And the window for everyday investors to get in before the next major shift is closing fast. Let me show you what's really going on behind the scenes, because what you're seeing in the headlines is only a fraction of the story. Gold has been climbing steadily, breaking through resistance levels that held for years. Silver has been following, but with a volatility that tells us something bigger is brewing beneath the surface. The question isn't whether precious metals are going higher. The question is whether you'll be positioned before the real move begins. Think about what's happened over just the past few months. We've seen gold push through psychological barriers that traders thought would hold for years. We've watched silver spike and pull back in a pattern that historically precedes major breakouts. And all of this is happening while the mainstream financial media is focused on everything except what matters most to your wealth. Here's what they're not telling you. The physical market for precious metals is tightening in ways we haven't seen since the financial crisis. Refineries are running at capacity. Mints are struggling to keep up with demand. Premiums on physical metal over spot prices have been elevated for months, which tells us that people who actually want to hold the metal in their hands are willing to pay significantly more than the paper price suggests it's worth. That's not normal. That's a warning sign. And it's not just retail investors driving this demand. Central banks around the world have been net buyers of gold for years now, but the pace has accelerated dramatically. We're talking about hundreds of tons being accumulated by countries that are actively working to reduce their dependence on the dollar. China, Russia, India, Turkey, Poland, Singapore. These aren't small players making symbolic gestures. These are major economic powers making strategic decisions about the future of their reserves. Why would they do this? Because they see what's coming. They understand that the monetary system we've operated under for the past 50 years is showing cracks that can't be papered over anymore. When Nixon closed the gold window back in '71, he set in motion a series of events that we're still dealing with today. The dollar became a pure fiat currency, backed by nothing except the faith and credit of the United States government. And for decades, that was enough. The dollar was the undisputed king of global reserve currencies. Everyone needed dollars to buy oil, to settle international trade, to hold as reserves. But that dominance is eroding. Not overnight, not in a dramatic collapse, but slowly, steadily, as countries around the world look for alternatives. The BRICS nations have been working on alternative payment systems. Trade agreements are being signed that bypass the dollar entirely. And every time the United States uses the dollar as a weapon, freezing assets or imposing sanctions, it gives other countries another reason to look for alternatives. Before we go further, I want to mention something quickly. If you're watching this and you're concerned about protecting your wealth in this environment, I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, no obligation. Just information that could make a real difference in how you approach the next few years. Now, let's talk about what this means for precious metals. When countries lose faith in fiat currencies, they turn to the one asset that has held value for thousands of years: gold and silver, which has both monetary and industrial demand working in its favor. We're watching a slow-motion shift in the global monetary order, and precious metals are the beneficiaries. But it's not just about geopolitics. The fundamentals of supply and demand are working in favor of higher prices too. Gold mining production has been essentially flat for years. The easy deposits have been found and mined. New discoveries are rare, and when they do happen, it takes years and billions of dollars to bring a new mine into production. Meanwhile, demand keeps growing, not just from central banks, but from investors, from jewelry buyers in Asia, from technology companies that need gold for electronics. Silver's story is even more compelling in some ways. Silver is consumed in industrial applications at a rate that far exceeds gold. Solar panels, electronics, medical devices, batteries. Every electric vehicle uses significant amounts of silver. Every solar panel installation requires silver, and as the world pushes toward renewable energy and electric transportation, that industrial demand is only going to increase. But here's the thing. Silver mining is largely a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. The rest comes from lead, zinc, copper, and gold mining, which means that silver supply doesn't respond to price increases the way you might expect. Even if silver prices double, we're not going to see a flood of new supply hit the market quickly. This creates a situation where demand is growing faster than supply can keep up. And when you combine that with the monetary demand for silver as a store of value, you get a recipe for significant price appreciation. We've seen this movie before. In the late 70s, silver went from around $4 an ounce to over $50 in just a few years. In 2011, it ran from under $20 to nearly $50 again. Both times, it was driven by a combination of monetary concerns and supply constraints, and both times the move happened faster than most people expected. Are we setting up for another move like that? The conditions are certainly in place. Inflation is still a concern despite what the official numbers say. Anyone who buys groceries or pays rent knows that the cost of living is significantly higher than it was a few years ago. And while central banks have raised interest rates to try to combat inflation, they're in a bind. Raise rates too much, and you risk triggering a recession. Keep rates too low, and inflation stays elevated. It's a no-win situation, and precious metals tend to do well in exactly this kind of environment. Let's talk about what's happening in the paper markets, because this is where things get really interesting. The COMEX, the major exchange where gold and silver futures are traded, operates on a fractional reserve system. For every ounce of physical metal in the vaults, there are multiple claims on that metal in the form of paper contracts. Most of these contracts are settled in cash, not physical delivery. But what happens if a significant number of contract holders decide they want actual metal instead of cash settlement? That's when you get a squeeze. That's when the paper price and the physical price diverge dramatically. And we're already seeing signs of stress in the system. Look at what happened in the nickel market a few years back. A short squeeze forced the London Metal Exchange to halt trading and cancel trades. Billions of dollars were at stake, and the exchange essentially rewrote the rules to prevent a complete meltdown. Now, gold and silver markets are much larger and more liquid than nickel, but the same dynamics apply. If enough people demand physical delivery, the system doesn't have enough metal to satisfy everyone. And that's when prices can move in ways that seem impossible until they happen. The smart money understands this. That's why we're seeing institutional investors and family offices quietly accumulating physical metal. They're not buying paper ETFs that may or may not be fully backed by physical metal. They're buying bars and coins and storing them in secure vaults. They're taking delivery. They're removing metal from the system. And every ounce that gets removed makes the system that much more fragile. Here's something else to consider. The ratio between gold and silver prices has been historically around 15-1, meaning it took 15 ounces of silver to buy 1 ounce of gold. That ratio has varied over time, but it tends to revert to that historical mean. Right now, the ratio is much higher than that, which suggests that either gold is overvalued relative to silver, or silver is significantly undervalued relative to gold. Given the industrial demand for silver and the supply constraints we've talked about, the smart bet is that silver is undervalued, and when that ratio starts to correct, silver could move much faster than gold. Now, I know some of you are thinking about your retirement accounts. You're wondering how you can participate in this without having to sell your stocks or bonds or mutual funds, and that's where a gold IRA comes into play. If you're sitting on $100,000 or more in retirement accounts, you have options that most people don't know about. You can actually move a portion of your retirement savings into physical gold and silver without triggering taxes or penalties. I've put together a guide that explains exactly how this works. It's in the description. It covers the process, the rules, the benefits, and the potential pitfalls to avoid. If you're concerned about market volatility, about inflation, about the stability of the financial system, this is worth looking into. No pressure, no obligation. Just information that could help you make better decisions about protecting your retirement. Let me get back to the bigger picture because there's more to this story. We're not just talking about precious metals going up because of supply and demand fundamentals. We're talking about a potential reset of the entire monetary system. And I don't say that lightly. The current system of fiat currencies and central bank manipulation has been pushed to its limits. We've seen interest rates go to zero and even negative in some countries. We've seen central banks print trillions of dollars in new money. We've seen government debt levels reach heights that would have been unthinkable a generation ago. And here's the thing about debt. It has to be dealt with eventually. You can roll it over, you can refinance it, you can try to inflate it away, but you can't ignore it forever. At some point, creditors start to worry about getting paid back. At some point, the interest payments become so large that they crowd out everything else in the budget. And when that happens, governments have limited options. They can default, which destroys confidence in the currency. They can raise taxes, which slows economic growth. Or they can print more money, which causes inflation and destroys the purchasing power of the currency. None of these options are good, and all of them lead to the same place: a loss of confidence in fiat currencies and a flight to hard assets. Gold and silver have been the go-to hard assets for thousands of years because they can't be printed, they can't be debased, and they're recognized as valuable everywhere in the world. When people lose faith in paper money, they turn to precious metals. It's happened over and over throughout history, and it's starting to happen again. Look at what's happening in countries with currency crises: Venezuela, Argentina, Turkey, Lebanon. When the local currency collapses, people scramble to get their hands on dollars, or euros, or gold, anything that holds value better than the paper their government is printing. And while the dollar is still the world's reserve currency, it's not immune to the same forces. The more dollars that get printed, the less each one is worth. The more debt the government takes on, the less confidence people have in the currency's long-term stability. This is why central banks are buying gold. They're not doing it because they think gold is going to double next month. They're doing it because they understand that in a world of fiat currencies and unlimited money printing, gold is the ultimate insurance policy. It's the asset that maintains its value when everything else is in question. And if central banks are buying, shouldn't you be thinking about doing the same? Let's talk about timing, because that's what everyone wants to know. When is the right time to buy? And the honest answer is that nobody can predict short-term price movements with certainty. Markets can stay irrational longer than you can stay solvent, as the saying goes. But what we can do is look at the long-term trends and position ourselves accordingly. And the long-term trends all point in the same direction: higher prices for precious metals. We're in the early stages of what could be a multi-year bull market. Gold has already broken out to new highs, which is a bullish technical signal. Silver is consolidating, building energy for its next move. The fundamentals are supportive. The geopolitical environment is uncertain. The monetary system is under stress. All of these factors create a favorable environment for precious metals. But here's what you need to understand. The big moves don't happen gradually. They happen in bursts. You'll see months of sideways trading, and then suddenly the market gaps up and doesn't look back. If you wait for confirmation, if you wait for everyone else to recognize what's happening, you'll be buying at much higher prices. The time to position yourself is before the crowd figures it out. And right now, we're still in that window. Think about the people who bought gold in the early 2000s when it was trading around $300 an ounce. They were called crazy. They were told that gold was a barbarous relic with no place in a modern portfolio. And then gold went on a 10-year run that took it to over $1,900. The people who bought early and held on made life-changing returns. The people who waited until gold was already at $1,500 still made money, but not nearly as much. And the people who waited until gold hit its peak and then bought out of fear, they lost money when the market corrected. The lesson is clear. You want to be early. You want to be positioned before the crowd arrives. And right now, despite the recent strength in precious metals, we're still early. The mainstream financial media is still skeptical. Most financial advisors are still recommending traditional 60-40 portfolios of stocks and bonds. The average investor still has little to no exposure to precious metals. When that changes, when precious metals become the hot investment that everyone is talking about, that's when you know we're near the top, but we're nowhere near that point yet. Let me share a story that illustrates this perfectly. Back in the late 70s, there was a famous investor named Jim Rogers who, along with George Soros, ran one of the most successful hedge funds of that era. Rogers saw the inflation coming. He saw the weakness in the dollar. and he positioned his fund heavily in commodities, including gold and silver. People thought he was crazy. Commodities had been in a bear market for decades. But Rogers understood the fundamentals. He understood that the monetary policies of the time were going to lead to inflation and a flight to hard assets. And he was right. His fund made extraordinary returns while most investors were losing money in stocks and bonds. The point is that the big money is made by seeing what's coming before everyone else does. And right now the signs are all there if you're willing to look. The question is whether you're going to act on what you're seeing or whether you're going to wait until it's too late. Now let's address some of the common objections people have to investing in precious metals. The first one is that gold and silver don't pay dividends or interest. They just sit there. And that's true. But that's also missing the point. You don't buy precious metals for income. You buy them for wealth preservation and capital appreciation. In an environment where currencies are being debased and financial assets are overvalued, having a portion of your wealth in assets that can't be printed or manipulated is invaluable. Think of it as insurance. You don't buy insurance hoping to collect on it. You buy it for peace of mind and protection against worst-case scenarios. The second objection is that precious metals are volatile. And again, that's true. Silver especially can swing wildly in the short term. But if you have a long-term perspective and you're not trying to trade in and out, that volatility is just noise. What matters is the long-term trend. And the long-term trend for precious metals in an environment of monetary instability is up. The third objection is that you can't eat gold or silver. In a real crisis, people will want food and water and ammunition, not shiny metal. And while there's some truth to that in an extreme scenario, it's also a bit of a straw man argument. We're not talking about a Mad Max apocalypse here. We're talking about a gradual loss of confidence in fiat currencies and a shift toward hard assets. In that scenario, which is far more likely than a complete societal collapse, precious metals are exactly what you want to own. Here's what I want you to take away from this. We're living through a period of unprecedented monetary experimentation. Central banks have printed more money in the past few years than in the entire previous history of their existence. Government debt levels are at all-time highs. The global reserve currency system is under stress, and the traditional safe havens of stocks and bonds are both expensive by historical standards. In this environment, having exposure to precious metals isn't speculation. It's prudent risk management. The reset is coming. Not tomorrow, not next week, but it's coming. And when it does, the people who positioned themselves ahead of time are going to be glad they did. The people who waited are going to wish they hadn't. This is your last chance to get in before the next major move. Not because the opportunity will disappear entirely, but because the risk-reward ratio is never going to be this favorable again. So what should you do? First, educate yourself. Understand what you're buying and why. Don't just take my word for it. Do your own research. Look at the fundamentals. Look at the charts. Look at what central banks are doing. Second, start small if you need to. You don't have to go all in on day one. Build a position over time. Dollar cost average if that makes you more comfortable. But start. Don't let analysis paralysis keep you on the sidelines. Third, think long term. This isn't a trade. This is a strategic allocation to protect and grow your wealth over the next several years. And if you're someone with significant retirement savings, if you have $100,000 or more sitting in traditional retirement accounts, you owe it to yourself to understand how a gold IRA works. The guide I mentioned earlier is in the description. And here's something special for those of you who've watched all the way to the end. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video, you'll get access to an exclusive one-on-one educational web conference. No obligation, no pressure, just a chance to learn from experts who can walk you through your options and help you make informed decisions about protecting your wealth. This is only available to people who meet those criteria and who mention this video. So if that's you, take advantage of it. The window is closing. The smart money is already positioned. Central banks are accumulating. Institutions are moving. The fundamentals are aligned. The technical picture is bullish, and the geopolitical environment is creating exactly the kind of uncertainty that drives people towards safe haven assets. Everything is lining up for a major move in precious metals. The only question is whether you'll be part of it or whether you'll be watching from the sidelines wishing you had acted when you had the chance. This is your moment. This is your last chance before the reset. Don't let it pass you by. Ask Galaxy AI.